Welcome to anyone who's recently joined. We're just going to wait one more moment for people to continue joining, and then we'll go ahead and get started. Okay, I think we'll go ahead and get started and people can keep joining as we go through the introduction. So hello and good morning or evening, everyone. Thank you for attending this DCO webinar. For those of you who don't know us, my name is Marissa McCassin and I'm a program associate at the Center for Effective Global Action, or CEGA, a research center based at UC Berkeley. My colleague, Leah Bridle, and I work on a research initiative called the Digital Credit Observatory, or DCO. The DCO was established in 2016 from support with the Bill and Melinda Gates Foundation to support a coordinated portfolio of rigorous research on the impacts, both positive and negative, of digital credit products in emerging markets. Since 2016, we've funded 16 studies across 3 continents. As many of these studies finalize results over 2021, we plan to continue hosting DCO webinars to share what they have learned and hope that you will subscribe to our newsletter for future invitations. I'll go ahead and put the link in the chat after this. Today, we are excited to hear results from CEGA affiliate Alfredo Burlando and co-author Sylvia Prina. They will share what they have learned about the effect of digital credit disbursement delays on borrowers' behavior and what implications we can draw from these findings. So just a little bit about how we're going to run the call. We ask that you use the question and answer function for questions. The research team will answer clarifying questions via the Q&A text during the presentation. And then we plan to reserve 10 to 15 minutes for questions after the researchers have finished sharing results. The chat will be disabled, but the Q&A will be open and you'll have the ability to upvote questions. So without further ado, I'll turn it over to Sylvia to get started. Thank you everyone for being here.
Thank you everyone for being here. And thank you for inviting us to present our research. I'll be presenting a new paper that's called Too Fast, Too Furious, the impact of digital credit speed on repayment. As mentioned by Marissa, this is joint work with Alfredo Burlando, who will be doing the second half of the presentation, and Mike Kuhn, both at the University of Oregon. So as we all know, digital credit are consumer loans that are delivered remotely via phone or computer. They are characterized by being fully automated. There is an automated application as well as an automated screening. And loans are delivered in some cases within minutes and in other within hours. This is a relatively new setting. And so there is a fast growing literature. We have evidence that these digital loans can be good in the sense that they can help households confront emergency as well as cope with liquidity needs. Nevertheless, there is a host of consumer protection issues that are associated with this type of digital loans. Why? Well, we have issues of over-indebtedness. People might have trouble repaying these loans, and the loan terms are often unclear. So people don't know what they're getting themselves into. In our paper, what we're going to specifically try and deal with is the speed of digital credit, as the title of our research says. And this is a consumer protection issue because one can think that these digital loans that are delivered within minutes or hour might lead to rush decision making. And this can affect two broad topics. On the one side, we have instant gratification, meaning that given that the loan process is easy to apply to, and then you can get the loan within minutes. One could say like, well, I'm going to get a loan without thinking like too much about, am I going to be able to repay it, or do I really need this type of loan? And then on the other side, there is like lack of deliberation, either with oneself or with your partner or like your household in terms of, again, ability to repay. So in our paper, what we do is we estimate the effect of imposing delays in digital credit, and we'll talk about how we're able like to actually look at this using administrative records of loans from a digital lender in Mexico in the period between 2018 and 2019. And we're going to be using quasi-experimental variation in the delivery of like these loans due to quirks in the loan delivery process that we'll take advantage of. So just to give you like a roadmap, first we'll start talking about the loan processing from like our Mexican lender. Then we'll move on to like the identification strategy. We will use like regression discontinuity, and then discuss like the results from the regression discontinuity. We'll move on to the mechanism and conclude discussing the policy implication associated with our results. So let me tell you about the setting briefly. As I said, we have administrative data from a digital lender in Mexico. The lender uses an internet-based interface, which borrowers or applicants can access either via computer or via mobile phone. The APR in our setting is up to 480%, and the loan duration goes like from a week up to a month. The loan size is up to the equivalent of $150. So what we take advantage of is the fact that the back-end processing of approved loan relies on live agents, not on machine, for a small part of this. So we have access to 15,000 loans from all the universe of like successful borrowers, meaning people who applied and then were granted a loan from November 2018 up until May like 2019. And we have access to first, second, and third loans, which means that we are also able to distinguish between first-time borrowers as well as what we call repeat borrowers. The type of information that we have goes from the timestamp of like the loan application, the disbursement, as well as like repayments and default indicators. So here is just like one example. We are on February 1st, so getting close like to Valentine's Day. And so we picked an appropriate screenshot from a digital lender in Spanish, which says, fall in love like this season using a loan from us. And as you can see from the screen, you have to select if you want to apply like for such a loan, as I'm going to show you soon enough. Marisa, Alfredo, Mike, and myself are going to be applying for one of such loans and be successful applicants. You have to select like the amount, you have to select like the term that in this case goes as for our lender from 7 like to 30 days. And then once you have selected this, the website calculates the interest rate like for you and the total amount of money that you will have to pay at the end of the term of your loans. It also features there like the date by when like you have to repay like the loan, and the CAT there is the equivalent of like the APR in Spanish, and in this setup is close like to 600%. So in our setting, what happens is that clients submit an application online. This is what we call like loan submission. There is an immediate screening, and what the lender does is to pull off like the credit score from the credit bureau. And then there is approval or rejection within like seconds. After that, there is a verification process. And once the loan has been like verified, the loan is placed in what we call a disbursement queue, or in other words, like a batch. What does it mean? Well, it means the loans, as we're going to see in the next slide, will slowly like accumulate in this queue until an employee will essentially like take that queue and forward it to the bank for disbursement. And this happens 2 to 4 times like a day, depending on the day. There are no specific times, and there is no specific like length of the queue there. So banks, the bank, once it receives like these loans, this list of loans, it processes the loan immediately. And so the funds are deposited in the borrower's account and are available like for use. And this is what we call loan disbursement. So let me just give you a quick intuition of the identification strategy, and then we'll go through like an example. The intuition is that essentially in our empirical analysis, we're going to be comparing loans that are very similar, but because of the way loans are processed, they're going to be taking some a shorter time and some a longer time to actually like be deposited. And so what we're going to be doing is comparing loans that are very similar, but that just differ in the amount of time that it takes to be deposited, or in other words, like the delay, the del phase, and compare the likelihood of repayment, distinguishing them by the length of the delay. And so just to understand this a little better, imagine the loan application are coming in like every minute. So here is an example. We have 3 people. One is Alfredo, the other one is Mike, and then there is myself, that are applying like for a loan. And so we submit our loan application, Alfredo at 8:04, Mike at 8:05, and myself at 8:06. So we are 3 different clients. What happens is that the loan processing time takes, in this example, like 3 hours. And so what this means is that the bank processes and approves like our loan at 11:04, 11:05, and 11:06, like respectively. What happens then at 11:04? Well, at 11:04, Alfredo's loan gets picked by the employee and gets added like to a list. So we had the previously approved loan for Marissa, and now to that list, the employee also adds Alfredo's loan. Then what happens is that at 11:05, Mike's loan gets also approved, and so Mike's loan gets added like to the list of Marissa and Alfredo's loans. Now, a minute later, my loan will also get approved and get put in a list. Nevertheless, what happens is that at this point, at 11:05, what the employee does is to take the entire list, the entire batch of loans, and send it to the bank for disbursement. And so what happens is that there is a batch that actually like gets submitted, and that batch includes Alfredo's loans and includes like Mike's loans, but it does not include like my loan, because due to a difference of like just a minute, my loan has not finished like being processed yet, and therefore it does not get sent to the bank or like disbursed into my account. What happens though is that my loan just a minute later gets getting processed, and so gets added to what is a new queue. So that's my first loan. It's up the first loan up there on the queue is actually like my loan. And what this implies is that then that batch, that list, will have to get populated up until like an employee yet again later in time is going to take that batch and send it again to the bank. And that's going to happen, like in our example here, about like 7.5 hours later. So what we can see here is that if we look at Alfredo and Mike's loans versus mine, they are not different. We applied roughly like at the same time. There is a 1 minute difference or 2 like between these loans. But what is different is the fact that my loan faces a delay of 7.5 hours with respect to the one of Alfredo and Mike's. And so the key point here is to say like, well, if we think that this process is somewhat like rushed and we don't have any time to actually like think about the usage of the loan, whether I really need it, how am I going to repay it, potentially like deliberate like some like with my partner, or simply like thinking about it like on my own, the difference in delay it might affect myself differently than the way it might affect like Alfredo and Mike. And this is exactly what we're going to study. So in our strategy, what we're going to be doing is to use discontinuity in processing time due to this queuing process that I just discussed. And we're going to be comparing loans that are submitted around the same time, as in the case of Alfredo, Mike, and I. And some make it into the current batch, and others are going to be dispersed in the next available batch, and they will take hours longer like to deliver, as in my case. So what we're going to be calling as batch cutoff time is literally like that red line that I showed you earlier, between that divides one batch like from the other. And so the last batch that made it to the cutoff was Mike's before, and mine was the first loans that actually made it to the next loan. And so the last moment in time a borrower can submit an application and has a chance to make it into a certain batch is what we call batch cutoff time. So we're going to be using this in a regression discontinuity framework to try and estimate the effect of processing speed on repayment. And now I'm going to pass the baton to Alfredo and mute myself so that he can keep talking about this.
Thank you, Sylvia. So it's my turn now to complete the presentation. I will show you the results of the study, and then we'll think about what could be driving the results that we see. So the goal of the exercise, of the empirical exercise, as Sylvia explained, is to estimate the effect of processing speeds on repayment. Again, the processing speed is going to be identified by these loans that just missed this batch cutoff in our regression, and the repayment is going to be an indicator, so a 0-1 variable that indicates whether a particular loan was repaid by the borrower at some point in the future. Okay, so the regression, you can see it in this slide, is the regression discontinuity regression. And the variable that we're interested in, the independent variable that we care about, is post-batch. That again identifies those loans that missed the batch cutoff and therefore are delayed. The coefficient estimate that we will keep track of is beta 2. Beta 2 measures the effect of being delayed on repayment. So I will show you tables with these estimates. Some technical details for those of you who are so inclined to follow those technical details. We're using a bandwidth selection model from Calonico et al. And we are also using what we call the half donut design, where we're dropping the loans that were submitted right at the cutoff and within 20 minutes after the cutoff, for reasons that we're happy to explain in the Q&A or later on. And again, our results do not matter if we use alternative strategies if we run the regression in different ways, and if we vary this cutoff, we get the same results. Okay, next slide. Thank you. And so now what I'm going to show you is a couple of graphs. The first one that I want to show you is the effect of missing the cutoff on how long it takes for the borrower to receive their money after application. So on the y-axis, you have the number of hours that the borrower had to wait, and each dot represents basically loans. And what you see is the line in the middle represents the cutoff time. So to the left of the lines are those loans that were applied right before the cutoff and therefore are quicker. And then on the right side, we have these loans that were applied right after the cutoff and therefore we expect to be slower. And you really can see that there is a clear difference here in the average speed, that loans on the left take approximately 9 to 10 hours to get processed and submitted to the bank account of the borrower. And on the right, on the other hand, the amount of time that clients have to wait essentially doubles. Not only the amount of hours doubles, but also the likelihood that a borrower basically that applied today does not get the loan today, but gets the loan tomorrow increases or fall. That increases or significantly as well. So there's a delay. The additional delay is also sort of a next day effect, and we'll use that to think about our results later on. Okay, and now I'm gonna this graph shows you basically the main results of the paper, and here on the y-axis what we have is the likelihood that loans are repaid, and again you can see that there is a discrete jump here after the cutoff, that loans to the right are more likely to be repaid than loans on the left. Now, how big is that jump? We can look at the regression table to have a sense of the size of that jump. Next slide. And here is the table here's the table where we show you basically the regression estimates using a variety of methods, using a variety of control variables. If you look at the last column, column 4, the number in blue, that 0.056, that is our estimate for the effect of missing the cutoff on the repayment. And that number basically tells us that missing the cutoff and therefore being delayed increases repayments by 5.6 percentage points. Now that 5.6 percentage point increase in repayment is, the other way to think about it, a 5.6 percentage point decrease in the likelihood that the loan is defaulted. So given that in our sample we see approximately a 27% default rate, then that's a quite large decrease in default. That represents approximately 20% decrease in defaults, meaning that 1 in 5 defaults actually gets avoided when the loan is delayed. That's quite large. I'll talk a little bit about the size of these effects in a moment. Before I do so, we run a number of robustness tests so to see that our results actually hold. We estimate the effects for first-time and repeat borrowers, and we see similar effects. So it doesn't vary along a margin. We have some information from the characteristics of borrowers, some socioeconomic characteristics like sex, marital status, income, and credit score. What we find interesting is when we break borrowers by these variables, is that we see that most of the effect seems to be really loaded on the married sample. And so we see these effects of the delays on the married sample, not so much on the unmarried sample. We'll talk a little bit more about that in a moment as well. And then finally, we also break the sample into morning applicants and afternoon applicants. And again, think of these afternoon applicants as basically they apply in the afternoon, and therefore they're really, if they miss the cutoff, they're really very much less likely to get their loan right away or within the day. They're really getting delayed to the next day. And what we see is that the effect seems to be larger. It's present in both, but it seems to be much larger on those who applied in the afternoon. So with that, let me now discuss these results. And the first thing I want to discuss is the size effect, the fact that we see a decline in 20% in the probability of default, in the probability of default, and that's so when we commented that to other researchers, they thought, wow, that looks pretty high. How does that compare to the literature? And of course, as far as we know, this is the only paper that looks at a repayment or delivery speed of loans, and so there is no real equivalent literature that we could benchmark literature that we can sort of look and compare our study. However, so what we decided to do is to look at the microfinance literature, and the microfinance literature has lots and lots of studies where particular aspects of the loan process or the loan characteristics are experimentally varied in randomized controlled trials. And so we looked at the results of those RCTs to see what kind of impacts those tweaks in the loan characteristics were having on defaults. And what we have here in this figure is a variety of other studies that look at things like increasing the grace period for repayments or providing dynamic incentives. And what we find is that basically our estimate, both the point estimate and as a fraction of defaults, are more or less within the bounds of what we see from these other studies. Again, they're doing different interventions, but the set of the results are quite similar. So we think that our results are not necessarily super large; they're just consistent with the literature. So next, I want to talk a little bit about the channel. So what could be driving the results that we see now? Here, unfortunately, we're sort of limited in our ability to speak about mechanisms because we have only a limited set of data. We only observe certain characteristics of the borrower at the time of the application. And so it's hard for us to really really dig deep and be able to tell the story behind these results. So in particular, we lack things such as what were borrowers going to use the loan for, and what did they end up using the loan for. So intention is something that we are not able to measure. Having said so, there are some channels that we can definitely rule out, and then a few that we will not be able to. So let's first talk about those channels that we can absolutely rule out. The first thing that we can rule out is the possibility that delayed borrowers are more likely to immediately return the loan or decline. So imagine a situation where you're waiting. At some point you say, you know what, I don't want this anymore, and you just communicate to the lender, keep your money. I don't want to have it. And that's not what we see. And what we were able to obtain from the lender is a separate data set that looked at loan rejects. And what we see is that loan declines, so money that was supposed to reach the approved borrower, but then the borrower turned it back, they're very rare. We only see a couple of 300 loans that fit into that category. And so only 2% of the total loan sample that we have are declines. This is a very rare event. So that's not what's going on. Also, one thing that we observe is when the repayment of the loan. Once the loan enters into the bank account of the borrower, we see when that loan is repaid. And so we can see how long it took for that loan to be repaid. And what we see in the data is that loan returns immediately after the receiving the money are also very, very rare. Very few loans are returned before 7 days. And in fact, when we compare delayed loans and non-delayed loans, we see no difference in the repayment pattern in the first few days. And those differences really only start to emerge after a couple of weeks. So this is clearly not what's driving the results. So what could be driving the results? We have 4 stories that we can tell and that are consistent with our study. And again, we cannot rule any of them out. So let's just list them and then we can discuss. So the first one is the one that Silvia sort of motivated the presentation with, which is basically delayed loans. Borrowers who have delayed loans have more time to deliberate, to think about how they're going to use those loans and how they're going to repay those loans. There is a growing behavioral economics literature here that suggests that waiting periods seem to be important in decision making. And so there are a number of papers that show that when you impose a delay in the process, so the consumer gets to decide, but then has time to basically, before taking the actual action, has time to think about it, that those actions actually change, and that the consumer seems to take actions that are more patient, and so potentially we think wiser. So we think that there is some potential for improvements coming from this increased deliberation suggested by the literature. In addition to that, we have these interesting results from the married and unmarried sample that really made us thinking about a intra-household decision-making process here that might be important. The impacts are, as I said earlier, are on married borrowers, which represent 50% of the sample. And the effects are also larger for afternoon applicants who receive the loan the next day, more likely to receive the loan the next day. So we think that maybe, the story that we like to think is something along the lines of, you apply for the loan, and if you get the loan right away within the day, then you spend it and you use it the way that you thought. But if not, you have to go home, face your spouse, face the music, and and then together you decide and you revise the use of the loan, or together you make a repayment plan that is actually more robust. And so these effects are really interesting. Potentially, we unfortunately cannot study them in greater detail. Now, these 2 channels would suggest a positive effect on these delays on the borrower. However, there is still possible that these delays actually had a negative impact on the borrower, and there's two stories that we can tell here. One is that the borrower applied to a digital loan because they wanted they had an urgent need, and by the time the delayed loan arrives, that need is gone. So basically, the application was for nothing, and so then the money gets returned at the end of when the repayment period ends. Alternatively, and even worse, it will be a situation where borrowers with an urgent need, they really need the money. The money is not arriving from the lender because it's delayed. So then they go online and apply, and they get another loan from another digital lender, of which Mexico has many. In that case, then the borrower ends up with two loans instead of one. And so it is liquidity, it has liquidity, at least in the short run. There is enough liquidity to repay this initial loan, but overall ends up with more debt, larger repayments, and so that in that case he would be strictly worse off. So all in all, then, if we want to think about the welfare effects, then we really need to think about the relative importance of these mechanisms. We think that all four of them are probably going to be present in some quantity, but the relative size matters, and unfortunately, therefore, the consumer welfare implications are a bit unclear. Now, do keep in mind that borrowers who repay the loan, so borrowers who default on their loans, are reported to the credit bureau, so their credit scores actually gets dinged by the default, and so avoiding these defaults definitely would improve the credit score of these delayed borrowers. But again, on the other side, we cannot necessarily say whether these consumers are missing out on consumption opportunities, or they're not taking credit elsewhere. So again, welfare implications for the borrower remain a point that we need to figure out with more work. On the other hand, we can also think about the lender. Okay, what's the effect on the lender? And here we can be a little bit more, we can be a bit more stronger, and we think that the effects actually are positive for the lender. We think, so first of all, we see that delayed loans are repaid with a higher rate, and so that's definitely good for the lender. Moreover, we can ask, okay, what happens to those delayed borrowers? Do they borrow again? And do we see that they are, and are they more or less likely to repay those subsequent loans? So we analyze those borrowers that were delayed the first time, and then we see if the second and third time they're still borrowing the second and third time. And what we see is that they're not borrowing at a lower rate than non-delayed borrowers. And so, and in fact, if anything, they might be borrowing slightly more, and they might be slightly more likely to repay future loans. So in general, the lender seems to be doing off quite fine with these delays. There are no later on demand effects that from these borrowers that the lender needs to worry about. So with that, let me first summarize the paper. And then I'm going to spend a few minutes as well to talk a little bit about the policy implications. So we use quasi-experimental variation in the delivery times of digital loans. We showed that delays improve repayment rates and reduce defaults by approximately 20%. And we think that these, we need more work to be done in this space to really understand whether or not these delays are a good thing. We cannot talk about the welfare effects for borrowers very clearly, but if these effects are positive, and if its deliberation is really what's driving these results, then this suggests that mandatory waiting periods for the delivery of digital loans is something that we really need to take a look at. And so in that spirit, let's talk a little bit about what we think are the mandatory waiting periods, and should speed in some sense be regulated? Should regulators really impose mandated minimum waiting periods? And here, let me be very clear, we are speculating. This is just a conversation based on our study. But again, more work needs to be done to really nail this. And we think our view is that the regulation of speed could really be a good thing, not just for borrowers, but also for lenders. and that there are potential benefits from mandated minimum waiting periods, some of which we talked about in this presentation. We saw how delayed loans are repaid with at a higher rate. That's good for definitely for the lender, possibly for the borrower as well. And moreover, our initial results would suggest that there's no real loss of businesses from existing clients. There are a couple of additional benefits that we don't explore in the paper, but we can think of would definitely occur with a mandated minimum waiting period. One is that it would eliminate what it's currently a rat race over speed. It's basically the race to be the fastest lender in the market. We see lots of examples in a variety of markets where lenders are advertising loans in minutes. They might be advertising the quickest loan in the market, and all that speed takes significant amount of investment from lenders to be had. It's not cheap to speed up the processing of loans. The most egregious example that we can think of is actually the Ant Group in China. They advertise what's called the 310 system, which means 3 minutes for the application, 1 minute for approval and transfer, and 0 human touch. And again, if in that sense, if that that leads to rash decision making, then putting a hard limit on how fast these loans would be a good thing. And then finally, if we impose a minimum waiting period, that really could, this rat race would stop, and lenders would not be able to compete in speed. And so, in some sense, then we think they would be competing along other dimensions. Now, what those other dimensions are, that's hard to know. But nonetheless, definitely one dimension that it would be good for consumers to see competition is competition over price, because as we said earlier, these digital loans are incredibly costly, and so reducing those costs would definitely be a good thing. And with that, we are through with the presentation. I appreciate all your attention, and special thanks to the DCO for their incredible support with this project. If you have any comments and feedback, please do email us, and we're keen to hear from you.
Great, thank you, Silvia and Alfredo. So we have just a couple of questions in the Q&A, and there's also one in the chat, but we'd ask people to use the Q&A feature if you have other questions. So one question which we can anticipate is interest in the socioeconomic characteristics. So we know you have a couple of details from people, but also about use of the loans. So the specific questions from Ale, you can see the text, but essentially it says, would interviews or surveys with some borrowers who missed the cutoff be feasible to understand repayment behavior and intention, especially for those repeat borrowers who hadn't missed the cutoff for their other applications? So do you have any thoughts on that?
Yeah, sure. I mean, and we really wish we had that. We were, our data came to us anonymized. And so it's not possible for us to go back to those clients and ask them how they use these loans. And we really would have loved to hear from them, both their initial thoughts and then eventually what they use those loans for. And in some sense, that is the test, right? If deliberation really matters, that's where we should see the change. First, you wanted to spend money on, I don't know, on betting in the soccer game, and the next thing you're buying groceries instead, or something like that. So we would love to have that. For that really to occur, I think a prospective study is needed to really be able to interview people in real time and get their intentions and then their actual use.
Great. And this next question, I think, is more of a clarifying question. Can you revisit or speak a little bit more about the socioeconomic variables that you have access to and how you consider them?
Yes, and maybe Silvia, I think we might have the table there.
Yeah, we can share. Yeah, we can share back like the presentation. Let me try to do that, because we do have.
We have information on the gender, on whether the person was married or unmarried. the number of dependents, the age, the income, reported income, and the credit score. And so you can see here that there are some heterogeneity effects on the marital status. We talked about the married sample being, you can see that 0.108. Those are the beta 1 coefficients that we were talking about. Only on the married sample, the effect is really coming from there. We don't see the effects on single, divorced, widow. Interestingly, so we see the effect when we look at income. We split the income by low income and below median and above median, and we actually do see the effects on above median borrowers. And it's sort of consistent with some stories that people that are wealthier might not be, they might be less attentive to the way they spend some of their money. And then when we look at credit scores as well, we see the effect being a little bit stronger on the higher, the better credit scores. I don't think we have information on the, or we didn't really split by age or by, I guess by gender, the effect was stronger on women than on men, if I remember correctly.
And the other part that we have is what Alfredo mentioned earlier about like the time of the application. But that's all the information that we have. And just to like repeat and emphasize like what Alfredo said, like we would love and we're trying like to create a relationship with a potential partner to do a new study that would actually be able like to tell a lot more in terms of like all the questions that are being asked. I see like one more like in the chat about like, well, would like forcing borrower like to wait could have like negative effects for some people. For example, like if you have like an emergency like health expense, and yeah, potentially like that could be as we mentioned earlier, like have a negative like impact on is one of the two reasons that could have like definitely a negative impact on borrowers, right? Asking for a loan and having to wait when you have an urgent need, that would have a negative impact. And on the other side, also not wanting to wait and therefore like take up yet another loan and therefore like have two very expensive loans to repay. That would be like two potentially like negative impact that we cannot see, that we cannot observe. And so we would be really interested in moving forward like on a study that is able like to look at the overall level of like debt as well as like the welfare effect of like these households, which we tackle like these questions about negative impact of delays for urgent need. For borrowers that have an urgent need. Yeah.
Great. And maybe building out a question that just came in. So I know you don't have the information on how these particular borrowers use their loan, but do you have information from the lender you worked with on what this loan product typically, do they have any information or knowledge on what people typically use this for? So should people be thinking of this as a consumption loan or something that could be used for things other than consumption? And then a two-part question is then, would your same logic apply to both a consumption-oriented loan or something that's more business-oriented?
So in our case, well, we don't know, and the lender doesn't know. Truth be told, I don't think that the lender cares, like whether the loans are used like for a business or like a consumption reason. So they don't ask about it, and we don't have access to that information. Loan sizes, though, are relatively small, so are the equivalent of like $50 to $150. So for Mexico, that would not be like what would it's more likely that these are like consumer loans and not like investment, or if anything, they're not like huge like business like investment, probably like repairing maybe like a tool that you already have. So we do think that they are more likely to be like consumer loan. It's also the term of the loans might indicate that too. It's like a week to up to a month. So they're small loans with a relatively like short loan term. Whether that would apply like to business loans, I mean, my thinking is that it's unlikely that that's the case. And certainly would be interesting to see whether, I mean, it's more likely that if you apply like for a business loan, you have thought this like through like a little more. So instantaneous consumption is not really like key. I would hope that at least like the majority of people have like somewhat of a plan set in place in terms of like what your business gonna be, how you're gonna use like the loan that you've, so slightly more planning than a consumer loan. Yeah, and I can see one more question about whether there is an opportunity to interview some borrower to see what common loan purposes are. As Alfredo mentioned earlier, like we don't have access to a list of loan like from this lender, and also like this lender is no longer. I don't know, how can I say that, Alfredo? But it's no longer in the market.
Yes, not at least, yes, they've since we did the study, they've changed their business strategy. And so they're doing something completely different. And related to that, there is a question about what was being the reaction from the lender with the study findings. They didn't apply the results of the study. We had ideas of how they could maybe use speed as a way to separate, you know, to separate clients who have urgent needs and maybe, you know, charge them a higher interest rate than those are willing to wait for a slightly lower interest rate. But they were, you know, they were not in the, you know, they're not in the market anymore. And so just a comment came in from John saying that that he assumes that that's because of the huge default rate. I think that that's probably right. I think that perhaps they were not as good as in their models for, you know, the credit scoring models that they had were not up to snuff relative to the competition, and so that probably caused them. Unfortunately, we don't know what the default rates are for competitors. That's kind of like a something that would be really, really interesting to see whether or not they were that much worse than the competition. But yes, it could well be that there's that. From our informal conversations as well, they saw other business opportunities again in the credit markets, but slightly different segments, and so that's where they decide to move away from these individual credits to a different type of lending models. So we have a couple more questions here. One of the main reasons people prefer informal lenders is speed. Wouldn't mandatory waiting times be encouraging informality? Should be an aspect to look at. Absolutely. I mean, that is absolutely the case. That there are a couple of ways that you could think about, you know, taking the results. One is to say, okay, let's instead of just credit in minutes, if you could have segmentation where for urgent needs you have credit that is very, very quick at a very high interest rate, or slight delays that are a lower interest rate for people that are willing to wait, for example. So regulation could go in a variety of different ways. I do think that before we say, you know, mandated minimum waiting periods, you got to understand what's going on and what is the demand for speed. And our paper just cannot tell us that. We do not know what the demand for immediate loan is, and therefore we don't know the consequence for that immediate loan. And so absolutely further work is needed before regulatory action here should take place.
Great. Well, it looks like we've answered the questions coming in. I think we'll leave at least a minute or two left since we have some time, if others think of more questions. But thanks very much. It was really interesting.
Thank you for inviting us.
Of course.
Thank you for the invitation. And thanks for the questions.
Marissa, do you want to add the link again? Perfect.
Yes, so we hope if you enjoyed this that you'll continue attending DCO webinars and invite friends. So go ahead and subscribe if you want to continue to receive invitations. Thank you so much, Alfredo and Sylvia.
You're welcome.
All right, with that, I think we're just going to go ahead and end the webinar. So have a great morning or evening, everyone.